Hello and welcome to today's webinar on the latest federal budget announcements. I'm Amanda Castricum, partner at Mazars, and I'll be your host today. I would like to begin by acknowledging the traditional custodians on the land on which we gather today. We recognise their strength and pay our respects to elders past and present. Mazars extends that respect to all Aboriginal and Torres Strait Islander peoples and recognises their rich cultures and continuing connection to land and waters. The federal budget handed down by the Federal Treasurer, Dr. Jim Chalmers, on Tuesday was described as the responsible budget that helps people under pressure today, with the Treasurer forecasting a second consecutive surplus of $9.3 billion. The priorities of the budget were helping the cost of living, building more housing, investing in skills and education, strengthening Medicare, and responsible economic management to help fight inflation. To take us through the detail and unpack the changes announced, we have compiled a panel of tax and superannuation specialists across our offices. With that said, I'm delighted to introduce our first presenter, Meng Lee. Meng has over 20 years of experience in the tax profession and is an associate director with the firm. Prior to joining Mazars, he was a tax trainer with Tax Banter, Chartered Accountants Australia, and Webb Martin Training. Meng has presented seminars to clients ranging from the Australian Taxation Office, the Big Four, large mid-tier accounting firms, and small medium accounting practices. I'll hand over to you now, Meng, for detail on how the budget will impact individuals. Thanks.
Thanks, Amanda. While the budget was good news for the government from an economic perspective, from the perspective of individual taxpayers, there's one word to describe the budget, and that, of course, was underwhelming. There were no significant announcements made in terms of policy changes for individual taxpayers. In fact, the centerpiece of the budget, the changes to the Stage 3 tax plan, was actually announced prior to the budget at the end of last year. There were other changes that were also announced prior to the budget, which impact upon individual taxpayers. One of those, of course, was the removal of tax deductions for general interest charge and shortfall interest charge from the 1st of July 2025. The other measure that will potentially impact individual taxpayers was also announced prior to the budget, and that, of course, were the proposed changes to the foreign resident capital gains withholding regime. In particular, the increase in the withholding rate from 12.5% to 15%, and of course, the removal of the $750,000 threshold as well. If, as a commentator, I was asked to describe the impact of this budget on individual taxpayers, I would say that it was a budget of missed opportunity. The government has failed to progress any of the policy announcements that they made in prior budgets. For example, there's been no progress whatsoever on the proposed modernization of the individual tax residency rules. The other area that commentators and practitioners are crying out for reform in are rules dealing with the alienation of income, in particular the interaction between the personal services income rules and the general anti-avoidance provisions, the impact of alienation of income rules on professional services businesses. Once again, the government has failed to make any announcements in that area. The other area that the government has failed to make any sort of significant announcements or even consider making any changes, of course, is in the area of capital gains. There are numerous commentators that have called for reform of the CGT concessions, in particular, a reduction of the 50% CGT discount or a limiting of the capital gains main residence exemption. Once again, the government has resisted implementing such reforms, and hence, I would describe this budget from the perspective of individual taxpayers as being one of missed opportunity. Now, in terms of the changes that impact individual taxpayers, as I mentioned previously, the centerpiece, of course, is the changes to the Stage 3 tax plan. These changes have in fact been legislated and the legislation received royal assent in March of 2024. For those of you that are interested, the amendments were introduced in Treasury Laws Amendment Cost of Living Tax Cuts Act 2024. And as we've mentioned, these changes, of course, make some changes to the income tax rates and thresholds that will be applicable from the 24-25 income year onwards. One of the things that you will note is that the original Stage 3 tax plan provided more generous tax cuts for higher income earners. This revised Stage 3 tax plan, of course, does not provide as generous benefits for higher income earners, but it does provide, of course, some tax benefits for lower income earners. In terms of the actual changes, well, there's a reduction in the 19% rate to 16%. There's also an increase in the threshold at which the 32.5% rate previously applied to $135,000, and a reduction in the 32.5% rate to 30%. There's also an increase in the rate at which top marginal, there's an increase in the threshold at which top marginal rate applies from $180,000 to $190,000. So there are benefits provided to individual taxpayers, but the benefits for higher income earners, of course, are reduced when we compare these changes with the original Stage 3 tax plan. In terms of the actual numbers, well, if you've got a taxable income of $100,000, under the new Stage 3 tax plan, you stand to benefit by about $2,179. If you have a taxable income of $200,000, under the new Stage 3 tax plan, you stand to benefit by about $4,529. You'll note that under the original plan, taxpayers with taxable incomes of $200,000 stood to benefit by approximately $9,000. So, as you can see, higher income earners are disadvantaged by this Stage 3 tax plan, but of course, lower income earners, of course, are benefiting. The government, when they announced these changes, of course, basically tried to sell these changes on the basis that it's more equitable to spread the benefits around rather than just concentrating the benefits on higher income earners. What are some of the other notable announcements in the budget that impact upon individual taxpayers? Well, another interesting announcement, of course, was the changes to the Medicare levy low-income thresholds. For those of you that are wondering what this is all about, well, if your income doesn't exceed a certain amount, you're not subject to Medicare levy. And the government periodically, changes these low-income thresholds to basically keep in track with inflation. For the 23-24 year, basically the Medicare levy low-income threshold for singles has been increased to $26,000. And this is up from $24,276 for 22-23. So if your income doesn't exceed those thresholds, you don't have to pay Medicare levy. And you'll see there the other changes for couples with no children, families and seniors as well, fairly self-explanatory. One of the other notable announcements in the budget, of course, were the proposed changes to the indexation of HECS or help debts. One of the things that quite a number of students with HECS or help debts are griping about is the fact that in a high inflation environment, indexing HECS or help debts to CPI is actually quite a substantial financial burden on students. In a low inflation environment where CPI was negligible, indexing your HECS or help debt to CPI didn't have any significant impact on students in terms of a financial burden. But all of a sudden now, in a high inflation environment, indexing your HECS or help debts to CPI suddenly becomes a significant financial impost on students who are traditionally, less advantaged in terms of socioeconomic power. The government have now decided that, well, going forward, the indexation factor for HECS or help debts will be the lower of the consumer price index or the wages price index. And these changes will be retrospective from the 22-23 income year onwards. As an example, CPI in 22-23 was 7.1%, whereas the wages price index in that same period was 3.2%. So in that circumstance there, the HECS or help debts would be indexed to the wages price index rather than CPI, thereby ensuring that the additional financial impost on students is reduced. Most certainly welcome by the students with significant HECS or help debts. The other significant announcement in the budget was, of course, the government's proposal to extend the personal income tax compliance program for a further year from 1 July 2027. And this, of course, will allow the ATO to continue, its program and focus on areas of non-compliance, such as overclaiming deductions in relation to short-term rental properties. It will also allow the ATO to continue to educate taxpayers on appropriately claiming work-related expense deductions, and also educate taxpayers in terms of ensuring that they correctly report their income. This proposal is estimated to increase tax receipts by about $180.3 million over 5 years from 23-24. Last but not least, there were some significant non-tax policy announcements that are also going to impact individuals as well. One of those, of course, is the $300 rebate that will be applicable to all Australian households. And this will be applied against their 24-25 energy bills to assist households with increasing energy prices. One interesting observation about this particular concession, of course, is it's not means tested. So it doesn't matter, how economically advantaged a particular household is, they'll be eligible for this $300 rebate, to allay some of the increasing energy costs. For those of you who are intending on making a trip overseas, if you haven't applied for a passport and you're concerned that you may not be able to get your passport in time, the government has announced that from the 1st of July 2024, individuals will be able to pay additional fee of $100 and they get their passport application fast-tracked. And effectively, you'll be able to get your passport within 5 days, where ordinarily it takes a significantly longer period of time. In terms of the significant announcements for individual taxpayers, that was pretty much the extent of it. As I mentioned previously, a budget of missed opportunity, and a budget that's notable for what's not in it rather than what's in it. And I'd now like to pass on to my learned colleague, Robert, to cover off some of the budget measures that are going to impact upon business taxpayers.
Thanks very much, Meng. Like you said, it was quite safe, wasn't it? But there was certainly some positive news to come from this year's budget, particularly those that are feeling, the cost of living pinch, isn't it, at the moment?
Most certainly. As the budget was termed, a cost of living budget. Unfortunately, like I said, was no significant tax reform, but maybe in the next budget.
Fingers crossed. Moving forward now into the budget announcement, how they will impact businesses. I'm pleased to introduce our tax partner, Robert James. Robert is a chartered accountant with over 22 years business services and corporate tax experience. Robert has a proven track record in providing tax advisory services to a number of ASX listed companies, foreign multinationals, and privately held entities, including a number of our clients that are in the manufacturing and technology industries. Specifically, he has provided complex international tax structuring advice, ran tax due diligence projects for significant transactions, and assisted companies with successfully negotiating ATO reviews. He holds a Master of Tax, Bachelor of Business, and is a member of the Institute of Chartered Accountants Australia and New Zealand. Over to you. Thanks, Robert.
Thank you, Amanda. Well, the good and the bad news is that there really wasn't much in the budget for businesses. It's good news in terms of there's not going to be a whole lot of tax changes resulting from the budget that businesses are going to have to contend with, along with everything else they're contending with at the moment. The bad news is that it's a lost opportunity to start implementing some meaningful tax reform in the Australian tax system to try and ease some of the pain points that currently exist in our tax infrastructure. There were some important announcements made, so I'll go through those now. First one is the instant asset write-off for small businesses. And as you'll see there, we've got a table just to give a brief history lesson of what's been happening with the instant asset write-off since 1 July 2016. As you can see, the governments of the day have played with this measure, which essentially allows an upfront tax deduction for purchases of depreciating assets up to certain thresholds. So most of these measures over the history of them being in existence have focused on those small businesses, so those businesses with turnover of under $10 million. That changed slightly from March 2020, where medium-sized enterprises with turnovers up to $50 million were included. And then again, it was extended to larger businesses with turnover up to $500 million. And with COVID hitting, then we got temporary full expensing, which meant that businesses with turnovers up to $5 billion got to benefit from getting an immediate tax deduction from buying depreciating assets, and there was no cap on the purchase price. Now, coming out of COVID, the government started to wind back all its tax relief measures, and temporary full expensing did end on 30 June 2023. And that meant that at the time, the instant asset rules reverted to what they were pre-COVID. And there was a $1,000 purchase price limit for depreciating assets. And again, that only applied to small business entities. The government decided that wasn't good enough, so they introduced a bill to extend the purchase price threshold to $20,000, but again, limited to small businesses. That measure was meant to apply for assets purchased and installed ready for use from 1 July 2023 up until 30 June 2024. Unfortunately, the bill to make this measure law has not yet passed. It went to the Senate. The Senate recommended some changes. So the Senate wanted to extend the concession to businesses with turnover up to $50 million and also extend the purchase price ceiling to $30,000. And that went back down to the House, and the House, as of yesterday, voted down those proposed changes. So as it stands, it's up to the Senate what they do. If they let it go through as is, then there will be a $20,000 purchase price limit. So depreciating assets with a price of up to $20,000, small business entities can get a tax deduction for those purchases. The timing of the bill and it not being law is not helpful to businesses because we've got about 6 weeks left until 30 June 2024. And this measure, which is meant to apply from 1 July 2023 to 30 June 24, it's not even law yet. So it makes it very difficult for businesses to plan their capital spend and deciding on how and what they're going to purchase before 30 June 2024. Turning to the budget proposed to extend these measures up until 30 June 2025. And there was a hint in the budget papers that the Labor government wasn't going to support the Senate changes to extend these measures to medium enterprises and the purchase price limit to $30,000 because the extension solely was restricted to small business entities with turnover up to $10 million and the purchase price ceiling to $20,000. So we're still unsure about how this budget announcement will proceed, whether they'll try and amend the existing instant asset write-off bill or they'll just introduce a new bill. Whatever they do, we're just hopeful that the bill passes as close to 1 July 24 as possible, preferably sooner, to provide certainty to taxpayers in order to allow them to make informed decisions about purchasing capital assets to help them in their businesses. The next interesting announcement as part of the budget was the announced changes to the foreign resident CGT regime. So just in a nutshell, the amendments intend to broaden the range of assets, which will attract Australian capital gains tax for foreign residents. We'll also change the law so that the principal asset test will operate on a 365-day testing period. At the moment, it's a point in time test, which occurs at the time of the relevant CGT event. And it will also require foreign residents to let the tax office know if they dispose of shares or other membership interests in entities exceeding $20 million in value. Now, just taking a step back, as a broad brush statement, foreign residents are not subject to Australian capital gains tax unless the relevant asset is taxable Australian property. Now, taxable Australian property consists of direct interest and indirect interest. A direct interest is essentially a direct ownership in Australian land holdings or interest in Australian land holdings and certain mining rights. The indirect test applies two gateway tests. So there's the non-portfolio test and the principal asset test. So where a non-resident owns 10% or more in an entity, it ticks the non-portfolio test. And then you have to see if the principal asset test is also satisfied. The principal asset test looks to the underlying asset makeup of the relevant entity. And if more than 50% of the assets are taxable Australian property of that entity, and the foreign resident satisfies the non-portfolio test, then the disposal of their membership interest will be subject to Australian capital gains tax. And a few years ago, the tax office, or the government of the time, introduced foreign resident CGT withholding to make sure that when foreign residents were subject to Australian capital gains tax, that the government could actually collect the revenue. Of course, what was happening was foreign residents were selling assets and the money was going to them in foreign jurisdictions. And once the money leaves the Australian system, it's very hard to capture. So the withholding tax rules were introduced to try and get the money at source. So it's interesting that these changes have been announced. The government's obviously decided that it's missing out on some revenue in relation to these measures. The announcement was very scant on detail, so taxpayers and advisors alike will be watching this space with close interest to see the detail behind it. In terms of the 365-day tests, we're just not sure how this is going to work. If there's a point in time in the preceding 365 days from which the CGT event happened and an entity ticks over that 50% threshold, does that automatically mean that the principal asset test will be satisfied and foreign residents will be subject to Australian capital gains tax, even if for 364 days they're below the 50% threshold, especially at the time of the CGT event? Or is it going to be some type of averaging calculation? We'll just have to wait and see. But I think the underlying policy behind this is to increase revenue from non-residents in relation to Australian capital gains tax. And the third dot point about notifying the tax office, this is just in alignment with a movement across the world that's been happening over the last few years, is to provide revenue authorities with more information, greater transparency of what taxpayers are doing, with the thought being the more information that these revenue authorities have, the better they can target their audit activities and the more compliant taxpayers will be. So this measure is designed to work hand in hand with the foreign resident CGT withholding rules, so that no matter if a foreign resident sells shares, whether that underlying company has taxable Australian property, if the value of the shares is $20 million or more, the value of those shares is $20 million or more, the foreign resident's going to have to tell the tax office about the transaction, and then the tax office will be alerted, and they will probably do their own investigation to see if the disposal of the shares or other ownership interests should be subject to Australian capital gains tax. And just lastly, these proposed changes will apply to CGT events occurring on or after 1 July 2025. So in terms of the 1 July 2025 start date, the important thing to note is it's the date of the CGT event. So if the CGT event happens on or after 1 July 2025, then these amendments should apply to those transactions. If the CGT event, so the contract is entered into before 1 July 2025, then these measures shouldn't apply. So when these rules become law, foreign residents, if they're looking at a transaction that's around that date, they might look to bring forward those transactions. So generally, you'd say tax incentives are good for businesses. There were two incentives announced as part of these budget measures. So there's a critical minerals production tax incentive and a hydrogen production tax incentive. These tax incentives are targeted at specific industries and specific businesses, which means that there's a whole host of businesses that are missing out on tax incentives where they could probably deal with some government assistance to help them with the cost of living crisis that's currently before us. In terms of the critical minerals production tax incentive, scant on detail, but the general gist is that a tax offset of equal to 10% of the relevant processing and refining costs for Australia's 31 critical minerals will be provided to taxpayers between the 28 income year up to the 2040 income year. And it will apply for 10 years per project. And similarly, the hydrogen production tax incentive will provide a $2 incentive for every kilogram of renewable hydrogen produced between the 28 year and the 2040 income year for up to 10 years per project. We're not quite sure what renewable hydrogen means. When the draft legislation comes out, obviously more detail will be provided. The interesting thing is with the hydrogen production tax incentive, it's based on the hydrogen produced and doesn't provide any tax incentive up until that point. And I'm just cognizant that there can be a significant lead time from doing feasibility studies about hydrogen projects to getting them up and running. So it'll be interesting to see if these measures will actually attract greater investment in this area, or whether businesses who are going to proceed with these types of projects anyway are just going to get a free kick in terms of this tax incentive. Some good news, I suppose. A previously announced measure which was going to deny deductions for payments relating to intangibles that were housed in low or no tax jurisdictions. That measure is no longer going to go ahead. The reason being that the government earlier this year introduced the global minimum tax and domestic minimum tax measures, which is part of the global BEPS movement. And through those measures, then low taxed income will be addressed. So there wasn't a need for this additional measure because this global minimum tax and domestic minimum tax will address those types of arrangements. However, in the small print, the budget papers announced that from 1 July 2026, taxpayers will be penalised whether a significant global entity, i.e. global turnover AUD 1 billion or more, who mischaracterise or undervalue royalty payments to which withholding tax would otherwise apply. Those in the tax world would know that there was a large case, the PepsiCo case, where payments for the Pepsi syrup and the associated flavours from the Australian subsidiary was how to be a royalty, or part of it was how to be a royalty and subject to royalty withholding tax. PepsiCo has appealed that, so we're awaiting that appeal. But the government is obviously confident of winning the case, and it's just putting taxpayers on notice that payments that they might not necessarily think constitute royalties, they constitute royalties, and to make sure that they know where the line sits and they're paying the right amount of royalty withholding tax. Just touching on some other measures. In previous budgets, an ABN compliance obligations measure was announced that's no longer proceeding. That would have required ABN holders to remain up to date with their tax return lodgements and to make an annual confirmation that the ABN details were correct. Offsetting refunds against old tax debts. It's going to be legislated that the tax office will have discretion to not apply refunds automatically against old tax debts. The tax office has come out and said that's an administrative practice at the moment anyway, so this legislation aims to support that. There were proposed changes to the anti-avoidance rules, the Part 4A rules. They're still going ahead, but they're going to be delayed until the income year in which the relevant measures receive royal assent. Essentially, those measures were going to extend Part 4A to taxpayers to get an Australian tax benefit, but a greater foreign tax benefit. Those types of situations aren't currently covered, and also extend it to situations where a lower withholding tax rate is achieved or a no withholding tax rate is achieved through schemes. Small businesses are going to get a $325 payment. It's very similar to the payments going to individuals. If you're a small business, the retention of BAS refunds, the notification period will be extended from 14 days to 30 days. And that just provides the tax office with a bit more time to investigate unusual BAS lodgements and refunds to just make sure that everything is above board before they release the money, because there's been some fraud and evasion in the BAS refund space recently. And the tax office has been under a bit of pressure to do something about that. And just a small thing, there's going to be a reduction in fees in build to rent projects. As I alluded to at the start of the presentation, that's good and bad news. The bad news is it's a lost opportunity to start implementing some meaningful tax reform. So we'll just touch on what wasn't in the budget. Australia is still among the developed countries in the world, one of the countries that relies the heaviest on individual taxation. We still have no further guidance on tax residency, whether that be for individuals or companies. And it's getting increasingly difficult, especially for businesses to set up subsidiaries in foreign jurisdictions, to know where that threshold sits and to manage it, to make sure that the foreign subsidiaries are solely tax resident in the foreign jurisdiction. Because once you tick over to Australian tax residency, then you've got issues of dual tax residency, which increase complexity, and increased complexity is not good for anyone. It's no surprise, but GST is ripe for reform, but there's no announced changes in that regard. No changes to Div 7A. We're still subject to the complex rules that are currently in play, and the 100A measures and their broad application, we're hoping that they would be narrowed and more targeted in their approach, but again, no announcements in that regard. And that concludes my presentation. Back to you, Amanda.
Thanks very much, Robert. As you mentioned, we're still playing a bit of waiting game, aren't we, for a few of those measures. I think, personally speaking, as an accountant who's at this time of year, very busy, working with our clients on tax planning. It would have been good to have some clarity, particularly in relation to those depreciation claims on capital assets. So we'll sit tight, but thanks again for your insights. Our final segment, I'd like to introduce to you Frances Hill, who is a director of our superannuation division, who will provide a summary of the superannuation changes announced. Frances specialises in superannuation accounting and compliance with more than 15 years' experience. In addition to this, Frances is also licensed to provide strategic financial advice. Frances prides herself on supporting her clients through all stages of their superannuation journey and helping them to navigate the complex and ever-changing environment of super. Over to you now. Thanks, Frances.
Thanks, Amanda. It's probably a little bit interesting that we've talked about the ever-changing superannuation environment, given that in the budget this year that has left us with very little to talk about, but I will do my best. So just talking through the couple of items that were slightly superannuation related in the budget. We had the previously made announcement in relation to superannuation on paid parental leave confirmed. So this is effective 1 July 2025. Superannuation will be paid on government-funded paid parental leave. This will be paid via an additional payment that's based on 12% of your total paid parental leave payments and will be paid as a contribution to the fund of eligible parents. There's also a couple of announcements in relation to funding of some of the larger previously announced measures. So some of these date back to prior years, but the 2024-25 budget has made allowances for how some of these things are going to be implemented over the coming years. Most significantly is what we now know as Division 296 tax. So that was what was announced last year as the better targeted superannuation concessions. It's also more commonly known as the $3 million tax. So this announcement just gave some funding to the Commonwealth Superannuation Corporation and the Department of Finance to help them with the costs of implementing the measure for members of the Commonwealth Defined Benefit Superannuation Scheme. And I think what this really highlights is that all super funds, whether they're SMSFs like we see more regularly, or large funds, are going to have to allocate money to dealing with this tax, and that's a cost that's going to be borne by all members, regardless of what their balances are. So the second previously announced measure that had funding included in this year's budget was in relation to the implementation of the Payday Super scheme. So Payday Super is where employers will be required to pay your superannuation guarantee contribution at the same time as they pay your wages. Currently, this is paid on a quarterly basis at the end of the quarter, or in the month following the end of the quarter. So the Payday Super scheme is scheduled to commence from 1 July 2026, and funding has been allocated in this budget to help implement such a significant change to the superannuation system. The last of the announcements in the budget only impacts a few of our clients, but is in relation to the Social Security deeming rates. So that is an announcement that those rates have been frozen at the current levels, and this assists clients who have financial assets that are subject to those deeming rates when they're being assessed for eligibility of the age pension and the Commonwealth Seniors Health Card. Given there were so few budget announcements in relation to super this year, we wanted to spend a little bit of time going through a couple of the end of financial year considerations. This will help people who are looking at their tax planning and that type of thing with their current advisors, and also some information about some things that are changing from 1 July 2024. So most significantly is the increase to the concessional and non-concessional contribution caps. That comes into play from 1 July 2024, where the current cap of $27,500 for concessional contributions increases to $30,000. And then in the same vein, the non-concessional cap of $110,000 increases to $120,000. Probably of most significance to people for their planning activities is certainly from 1 July having a look at any salary sacrifice arrangement and redoing your calculations. And then also where non-concessional caps contributions are concerned. This is because people who trigger their bring forward in this financial year are subject to a combined cap equal to the current non-concessional cap. So that's 3 lots, or up to 3 times 110,000 or 330,000. Alternatively, if you trigger the bring forward in July, you would be eligible to contribute up to 3 times the new non-concessional cap, which is $360,000. It's important to note that the ability to make non-concessional contributions is linked to your total superannuation balance. So you need to double check that before you're looking to make any contributions. So reductions in the ability to bring forward apply currently for anyone with a total super balance of 1.68 million. But from 1 July 2024, it will apply for people with a total super balance of 1.66 million. And that calculation is done as of 30 June, the year before you're looking to make those contributions. Following on from that and linked to the discussion about salary sacrificing is also just considering the increasing super guarantee rate. So the next increase in that threshold applies from 1 July 2024, where we'll move from 11% to 11.5%, and then getting finally to that new 12% threshold from 1 July 2025. We also wanted to spend a little bit of time talking about probably the superannuation measure that is certainly generating the most discussion with our clients, and that is what we now know as Division 296 tax, or the previously called better targeted concessions. So as we've talked about previously, this is a new tax on large super balances, and it will impose an additional tax on people with a balance of 3 million or more. It's levied on the earnings of the individual's superannuation account that relate to their balance that is in excess of $3 million. If you do receive this tax, or if you are liable for this tax, it's something that you can pay personally, or you can elect to release the money from your superannuation fund. As it currently stands, the $3 million cap will not be indexed. And most significantly, in the last week or so, the Senate Economics Legislation Committee has been reviewing this cap and has received, or the legislation in relation to this cap or the tax. It has received submissions from a number of different industry bodies, but ultimately their recommendation at this time is that the bill proceed with no changes. So yeah, of importance, and I guess linking back to that is which is included in the legislation, is that confirmation that earnings are calculated based on your change in total super balance between 30 June 1 year and 30 June the year before. There is a mechanism that allows an adjustment for contributions and withdrawals, but what it is doing is essentially including unrealised gains, accounting adjustments, tax refunds, and other book entries in that calculation of earnings for the purpose of this tax. We've got a small example here to illustrate how this tax might apply to a taxpayer. So Pablo has a total super balance at 30 June 2025 of $4 million. By 30 June the following year, that balance has increased to $4.4 million, and that's purely on earnings. So he's made no contributions and he's also taken no benefit payments. So the calculation of his earnings for that year using the prescribed method in the legislation comes to $400,000 because we have no contributions or withdrawals to adjust for. We then have to look at the proportion of those earnings as they relate to his balance over $3 million. So the calculation there shows us that essentially it means that 31.82% of the earnings of his balance in the fund are in relation to that amount that is over the $3 million cap. The tax liability on that is at a rate of 15%, which is the same as the super tax rate normally. So that means that on that $400,000, he would have to pay an additional $19,092 of tax. And that's the tax that he would either be able to choose to release from the superannuation fund, or he could make that payment personally if that suits him. What this example illustrates is a couple of the issues or considerations with this new tax. Most significantly is that the tax is being levied on unrealised gains. So the increase in balance that Pablo has had from one year to the next could be purely in relation to revaluing a property asset in the fund and is not actually in relation to anything that's been realised. It also highlights that it might be a tax on unrealised gains that are never actually realised. Over the lifetime of that investment, while it may be worth $4.4 million at a point in time, over the following years, it may drop in value and may never recover to the level that it was assessed at. Any subsequent decline in value results in a loss, and this may not necessarily be able to be applied in future, depending on the mix of assets and the income and other things that play into that cap for him. So one of the other issues, and particularly around clients or funds with property investments, is cash flow and liquidity for funding these types of tax payments. If the tax has arisen as a result of an asset that doesn't generate a huge amount of cash flow, they may actually not be able to fund the tax payment from superannuation assets. So they're then left trying to find the ability to make that payment from resources held outside of the fund. The other one, which we've touched on earlier, is that the cap is not currently recommended to be indexed. And then finally, a lot of the time, or a lot of our clients, we're seeing they don't necessarily fall within the parameters for this tax at the moment, but in a situation where they received their spouse's super as a death benefit payment would suddenly bring them into this system. So some of the conversations we're having with clients are in relation to their options to deal with their super balances, or in situations where they think that they might be in a position where they will exceed the cap. And the conversations we're having at the moment are in relation to either leaving everything as is and paying the tax, because as is the case with any situation, when you are looking at pulling that type of money out of super, you do still need somewhere else for it to sit. It will still, generally, you would expect it to be invested. So then you need to make a decision around what entity that goes in and how that fits in your broader structure, whether that creates any issues from an estate planning perspective or any other potential risks to you personally with having that level of assets in your own name. There is also the option to start giving that money away. We're having conversations with clients around early inheritance or people who are starting to make some charitable donations, where that might ultimately be where they plan for their super to go. So they're just bringing that forward. We've been having lots of conversations around public and private ancillary funds and ways that people can feel like they're quite connected to the giving that they're doing. And then the final one is, I guess, investing in the last tax-free asset that people have, and that's your main residence. So either renovating, upgrading, basically putting the money into that, because that's still something that's increasing in value, but because it's subject to the main resident CGT exemption, means that the funds aren't in a taxable environment. So that's, pretty much the last of the super stuff for this year. Amanda, back to you.
Many thanks, Frances. That's great. Some positive news there for increases in our contribution limits, and also, I guess maybe on the flip side, we've still got our Division 296 complexities to work through. I think you've just addressed the importance of really that not just the superannuation, but also really that we've heard today of these federal budget announcements on how they might apply to your personal circumstances. Please feel free to reach out to your usual Mazars advisor, or alternatively one of our specialists. I'd like to thank all our presenters today for their excellent contributions and their insights on the federal budget. And more importantly, I'd like to thank you, our audience, for joining us. Thanks for watching and enjoy your day.